The system that you trade needs to be able to mitigate risk during large periods of consolidation. So what I'm going to talk to you about in today's episode is how to essentially trade a ranging market, how to trade through consolidations, how to trade through complex corrections. What should you do as a trader to avoid unnecessary losses, which are happening, by the way. Now, if you're someone who aspires to trade funded capital and you don't want to be that trader that gets to a few 100K in funding and then you just lose it all. And it's not because you don't know what you're doing. It's not because you're a bad trader, but your system didn't have a few things in place to mitigate those larger periods of drawdown. There are things called good losses and bad losses. How I talk about it in the sense of losses are unavoidable to a degree. Like, there is a randomness. You can't understand a reason why every loss has happened. But there are losses that what I see, they're just avoidable. They're unnecessary. And you guys have taken them before. You know what I'm talking about. So I'll just explain it to you. And I really hope this helps. This is something I wish was taught to me when I first started out in trading. It would have saved me so much stress. So we're going to look at this in the form of the DXY. So why is this important first and foremost? It's important because if you just zoom out and look, the market is more often than not, it's going to be in some form of a correction. You're not always going to get environments like this where it's very, very direct, and then you're just going to get long periods of trending markets. You're going to have stuff like this. It's going to last years, all of this. So you thinking that you're going to trade the same way every single time is extremely naive, and we get this a lot with new traders, or the traders that have been trading, I would say, a couple of years. You've been trading for a couple of years, it's just not long enough. And the reason as to why is that you just go to the DXY. Do me a favor, no matter how you trade, look at it and go look at the time frame 2021 to here 2022. You can see all of that price action. Imagine you started learning to trade here and all your experience is this. How are you going to know how to navigate through this if all you've ever traded is that? Can you see how we had that bubble in the prop firm space where people were just making quite a decent amount of money because when you were getting involved, the market was trending, there was nothing complex about it. But I can assure you, all you have to do is zoom out and go, well, this market here is not the same as this market here. This squeeze here on the DXY is going to be affecting a lot of things, especially if you only trade one or two instruments, or even if you trade a pair of four. Let's say you trade euro dollar, pound dollar, dollar CAD and Aussie dollar, for example. You're going to be affected massively by not knowing how to mitigate risk. So it's important to understand why. That's the important part, because if you're someone that you feel like the last couple of years has not been the same and you've been struggling, I understand why you've been struggling, but you could have mitigated risk by just understanding what to do in these periods. So the market is very rarely always trending, or it's complex. Like, for example, it could be moving in the upward direction but in a squeeze. That part here is super complex if you don't know how to deal with it. So you could actually be a decent trader, but if your environment is not working well, then guess what? You're not going to know how to damage control, essentially weather the storm. Before we get any further into this episode, make sure you are subscribed to the Market Brief. It is our free weekly newsletter. Every single Monday morning, you will get free weekly analysis delivered straight to your inbox. A few minutes a day and you'll be up to date with the financial markets. Links are in the description to subscribe to the Market Brief. So I'll show you in real time how I would do this on what's on watch. So this is my watch list for today. You might look at it and think, oh, there's quite a few on there. Look at my daily watch list. So my daily watch list is 5 pairs. Generally speaking, I'm only really dealing with 2 to 3. It's just there are so many key pairs and value areas, it would be foolish not to have a look at them. And this is the point. If you're only trading one instrument, you are going to be more likely to force trades during those really messy periods, and you're just going to put it down to, oh, my system has a lot of drawdown. I understand that, and although that can be true, wouldn't you rather be in a position where you had a bit of flexibility? I'm not saying have like 15 pairs on watch, but have something, right? So from my experience, this is what's worked for me anyway, and a lot of other traders. But let's take a look at pound Aussie. I'll show you what I mean of a consolidation. So firstly, what you got to understand is the way that you think about the market. Some people see it as manipulation and they're obsessed with these things. What you have to remember is, if you're worried about the market being manipulated per se, you're also going to be probably the trader that obsesses over stop hunt. So you think the market's always out to get you. I've got news for you. Your small account, they're not bothered about it. They're really not. And it's important that you hear this. It might not be what you want to hear, but it's what you need to hear. Your account is not being manipulated, because most of you trade on prop firm capital, which is simulated anyway. So what's being manipulated exactly? This is just market behavior. If something is being regularly manipulated, At what point does it not become manipulation? I mean, who's getting manipulated at the same time, all the time, every single time? It's just not a reality. So at what point is it manipulation, and at what point is it just market behavior? It's repetitive behavior that you see. So call it what you want. I don't see any value in looking at these kind of terms because it's just a little bit too negative. It doesn't really help you if you're thinking of the market in terms of I'm being stopped out, or this is where, you know, market makers, like, I get it, right? You want to understand all these different things, but fundamentally you're here to make money. So just food for thought. But anyway, range bound market. So if we look at pound Aussie and we're looking at this consolidation, this is simple, nothing complex about it. Original forecast, looking for price to tap into these areas. This consolidation here, this is way more complex. This whole entire range, if you don't understand what you're doing during this period, you could lose so much money. Good news is, it's way more simple than you think when you know the variables. So now that we're below this area, it's important to look at the higher time frame. So why was we looking for shorts on GA? Well, I can show you from a higher time frame point of view, which will make more sense. See how this low didn't get taken out, right? So you've got the obvious gap between this low and this low. This was the origin of the move. So essentially this is your impulsive leg. This is after a big consolidation. We come back down, phase 1, phase 2, phase 3. But in phase 3, we leave this gap. Now within this gap is likely to be filled. Now it doesn't have to meet the high before it gets there because we're in the middle of the range, which is a good sign, because what this has done is taken out this point. So we're taking out this high, we've consolidated where it's a bit complex, and then we get our follow through. So see it as the path of least resistance. Where is the price likely to go at this point after we've had weekly confirmation and we've taken out all of that consolidation? You can see we've got a heavy body candle there. Most people don't understand what that candle is. There's a difference between just your typical rejection versus a heavy body candle, which is this right here. This is more likely at this point from a probabilistic point of view to at least equal towards this low and then take out this low for the prior move. So that's really simple. That helps us because now we're set as a trader. Your mind is set in terms of this is the higher time frame narrative, then it's just lower time frame confirmation with my trading plan to execute. That's all you really need. You need a simple, effective plan that aligns with the higher time frame, have lower time frame execution, and just understand when you're over-analyzing on time frames that you shouldn't be, because sometimes we'll analyze on too low of a time frame. Now depending on your system that will vary, but you might be analyzing on an executional time frame, which shows me you're too zoomed in. And this is, again, when you don't understand how to mitigate risk in these ranges, you will lose a lot more than what you need to. So if we look at this on a daily, clearly dropped out. Look at the behavior prior. So again, when I speak about manipulation, this is what I mean. It would be very easy for me to say, well, look, the market manipulated above this area here. And then after we manipulated higher, we then came lower. This is just market behavior. I'll show you what I mean and how I would deal with this. So there's something that I call an insurance entry. An insurance entry is how we would deal with this scenario. So this is, we covered this in a live session. This is a great example. So you see how the market goes into a bit of an expansion on pound Aussie here. We create this high, we take out this low, we come back up to equal to that high. Eventually we take out this low. You could call that manipulation, whatever you want. We come back up. We get traders caught on the wrong side of the market. It's this point here that you need to understand why we was anticipating this sell. Remember what I said about higher time frame narrative? Higher time frame is already in play. So this is where I would expect people to get long in this period, and then it would just turn around. It would just roll over. It's regular market behavior. It's been happening. You can go and test it for years. If you want to throw into the mix this previous low that it tapped into, you can as well, using simple mechanics. So from that perspective, beautiful. A higher end of risk trade at the top, and then we have our entries a little bit below. But notice how that when we break these highs here and we come back in, what candle do we get, right? We get that heavy body that I showed you on the weekly, but we're also getting it on the 4 hour to break below these highs, which is crucial. But if I show you the prior trade, so let's say we're going to call this a consolidation. If I take it back here, this will make so much more sense. So here we have our consolidation. So imagine you're trading at this point and you're wondering, right, I'm in an area of value. This is where we could continue lower from phase 1, phase 2, phase 3. We have the expansion of price. We've already taken out the people at the low, and now we're looking for this one here. Well, you've got your 4 hour wick, but this is a bullish wick. Now you want to be careful with these ones when they almost wick towards price, because we're more likely to get a wick fill versus a rejection through. So what I was looking for was a double confirmation on the 4 hour. Now at one point, this area of price, we were wicking above and then we were closing lower. This was looking really promising that we would get a double rejection. Then I would look for the sell. So what I would do in this consolidation, and this is where people would get caught off guard where they're not trading ranges correctly, they take a lot of trades that have validity to them but carry more risk. So what you need to understand as a trader is the difference between trades that are higher in risk versus trades that are lower in risk. Now notice how I say lower in risk versus higher in risk, not low risk, high risk. There are trades. It would be naive to think at every system all trades carry the same element of risk. You need to know what type of trades that are higher in risk versus lower in risk. And then that puts you in a unique advantage because you can assess that situationally. So let's say you're trading on funded capital, right? You're trading on funded capital and you're in a position where you're wondering, right, what sort of trade should I take? How do I know? Are you just going to keep hammering trades and then wondering why you keep losing account after an account? No, what you want to do is you want to assess, can I afford to take the risk? There's one bit of value I could give you right now, write this down. When you're taking trades, can I afford to take the risk on this trade? And then you need to know, is this trade higher in risk or lower in risk? Now, you might be thinking, I've never even thought about that. Well, that's a big problem for you if your system doesn't allow that, because you're already in a position where you don't even know whether your trades are higher in risk or lower in risk. So in this scenario, right, is it higher in risk or is it lower in risk? Well, this is higher in risk to take the rejection at the top. So this would be your first trade. If you can afford to take the risk, someone could say, Mark, well, look, I'm looking to target these lows. We do have mechanical management as well, so I'll show you that. So for example, this is where our target would be. You would have your target around here. So you'd have it about 5.5. If I'm going to use mechanical management, I like to have at least a 5-to-1. So that meets the criteria. You would look at something like that. That would be your loss. That would be your -1. If you were running, or you was up 5% for the month, 6% for the month, I could mess with that one and say, well, look, it's valid enough. It meets all the criteria. It's higher in risk because this is an insurance entry job, but it makes sense. And in a certain period of time, that will work. This is not the type of trade that won't always work. This one, I mean, it would be really aggressive if you walked away with a break even. This is going to be more of your, I'm going to call this one a loss. Like realistically, this is a loss. And there's going to be a small percentage of people that were aggressive enough to get away with a break even, but I highly doubt it. So we call that one a loss, right? Can you afford to take the risk or not? The problem is, most traders are taking trades like this when they're already in -1. So that -1 becomes a -2, and they wonder why, without assessing the risk parameters, get more drawdown. And it's again and again, and they start taking higher in risk trades, more drawdown. And if they're really lucky, they'll get that one trade that takes them from -8 back up to, break even, or now -2. Your home runs, if you're now trading on funded capital with all of the rule changes, you're going to struggle with the consistency rule. You're not going to be able to be trading through CPI. All of these things that got you out of trouble before, you've built out some seriously bad habits. So now, such a risk if you don't have more of a robust system to be trading. So this is where I'd go, right, did the insurance entry, which was what you needed to do, an experienced trader trading this system, they would look at this scenario and go, right, I need an insurance entry. So then I ask myself, did the insurance entry do its job? Did the risk mitigation do its job in this scenario? Tick. And what I can do is I can go and test loads of these scenarios of the system and go, right, what would I do in this scenario? Another one would be higher above. You can see that we retested the back end of this. This was the first drive down. We'd be looking for rejections here. You can see on the 15-minute, 1 hour, there was no entry, so there'd be no reason why you would sell there anyway. But just say in some random scenario you did, or you put a limit order, which I wouldn't recommend. This is where you can't just be willy-nilly just putting random limit orders just because you think this is an area of interest or you think this is a valuable area and you just hit sell, right? If you're going to be doing that, you're going to be taking loss, and then you go, oh, what about the one above? Loss. I see this a lot with more scalper-based systems, but you see it so much, they're just taking so unnecessary losses. So I could look at that and go, right, perfect. This has done its job. The insurance entry model has avoided the loss. So there's a big difference between a loss that was just a really great trade and you just lose, versus this makes sense to be avoidable unless you are running 5, 6, 7% for the month. That's the type of trade that you take and go, well, look, if this puts me from +6 to +5, I'm okay with that. And then what do? We get our follow through, which is what we expect. Again, this is typical behavior. We come back in and then we start looking for AFT entries at this point. You're going to get quite a few, some more aggressive, depending on how you trade the system. So how we trade, you can be more swing style if you like, you can be more day trading, you can be more aggressive. It really comes down to your skill level. I'm not going to say comes down to your personality, because if you're a new trader, how on earth do you know what your trader personality is? You've not done the inner work yet. You can possibly know. What I'm saying is, it's important for whatever system you've got, you need to learn all of the areas of the system, not pick and choose and go, I'm a scalper. Like, how would you possibly know that? You need to understand the full understanding of the system itself, which is why I'm a big believer. Master one system, master your mind, you're going to be in a good position to make a lot of money. Where if you're chopping and changing, or your system can't deal with these periods, it's going to be difficult to you. Imagine you're trading a system where it's only in a trending environment. I've done that before. I know what that's like many, many years ago. You come unstuck very, very quickly. So when you're doing well, yeah, you're doing well for a period of time, but then when the market moves sideways or it's complex, you haven't got a clue what you're doing. So moving forward, right, we get the sell-off. This is typical behavior. So how would I now in real time use the same concept that I'm explaining to you to mitigate risk? What would I do in these scenarios? Well, as I explained prior, I was covering this trade in the midweek. So we've got our flat correction, nice and simple, retesting the back end of this low. Look at how we broke very impulsively. We've got our gap, right? So we've not taken that out yet. This is really important, these intricacies. So notice how, if I just zoom in, notice how every single time we sell off, we leave that gap, we come back up, we equal to that high, we leave the gap, we wick towards it, we leave that gap. We still haven't taken out that low. So what I want to do is I want to mark on these two lows. I can see that's not been taken out yet. So there's a high chance on the 1 hour we will eventually, based off of this correction, we will take out that high. So what we'll be looking for is a break above, or at least equal to that high, or retest there with a wick. That's okay. If we come back in, then I'm going to ask myself, am I going to take trades just there? Look, in certain scenarios, you might go, well, if I just set a limit order, I would be able to get in, and then I could get the top of the market. That's not what you want to be doing. That's not always going to work. You could take loss. We can avoid all of that, because what if you're only 3% away from losing your account? Is that a smart idea? No, it's not. You've got to apply common sense sometimes. So what I'll be looking for, because of how large this correction is, I'd be waiting for an insurance entry, right? The insurance entry around here, and then I'd be looking for a trade around this area. We're likely going to get in with about a 10 to 15 pip stop, and then I can target the bottom of the range. I've got two options, right? I'm either going to hold this whole move and look for a lot longer, or I'm going to apply mechanical management. I'm going to target 90% of the range, and that's going to put me about 8.7, 8.8. I'll tell you what, 8.8 for a simple run after we've mitigated risk, that's avoided a lot of losses. And then guess what? If that becomes a loss, that is what I call, that's a good loss, right? Because I've mitigated the risk for the right reasons. I've not randomly taken trades just because trades exist. You don't need to take every trade that meets your plan, because how could your plan ever account for every single scenario, in the sense of, you might have a trade set up in your plan that you go, yeah, this is in my plan. Okay, but you're minus 7%, one more trade, you lose your funded capital. It's higher in risk. Is this appropriate for you to take this trade? The logical side of you right now would be like, well, this makes so much sense. Of course I wouldn't take that trade. But why do you then? It's because fundamentally you've realized you don't know what trades are higher in risk or lower in risk. So you essentially don't know how to categorize the risk level of your trades. And then you're just taking random positions, not realizing that I almost guarantee I could have saved thousands of traders. Even, honestly, even if I have no idea whatsoever how you trade, I almost guarantee I could look at your trades, look at your journal, look at your situations when you were 2% away from losing your capital, and then you lost your funded capital. Could have saved you so much money just by teaching you how to mitigate risk. It astounds me. This is why within our fund, and I now start to understand the numbers so much more. There's a reason why we have traders that have kept their accounts over a year, over 2 years, not lost their account. Yes, some of them have experienced drawdown, but again, damage control. They know how to deal with these complex corrections, so they're not in a position where I almost guarantee I could pick out about 40 traders within the community that have still kept their accounts for over a year. If they didn't know how to mitigate risk, they would have lost their account 6 months ago. Hands down, they'd be going through the assessment phase again. They would never have kept their accounts because they wouldn't have understood how to navigate through something that's a bit more complex when there's a lack of commitment in the market or a lack of volume. They wouldn't know how to deal with it, or the system wouldn't allow for it to be able to mitigate. The good news is we've designed this in a way so it does mitigate those periods. So I'm so pleased to have this, and I encourage, if this gives you an eye-opening thought, like, I genuinely don't know whether this could apply to every single system. I'm confident it would apply to most if you're trading in a way where you understand liquidity, or you understand where most of the volume is going to step in. If you're trading in a way that's incongruent with where the bigger money steps in, so the institutions, the funds, where a lot of volume steps in, whether that be London or New York session, I'm confident that's going to help you out. If it isn't and you're trading something completely different, then maybe it doesn't apply to you. It's not going to apply to every system. But from what I've seen, this is extremely valuable. It's kept me out of so many trades. So now I know I can look at something like pound Aussie, for example, and then go, well, look, this is what I'm looking for. This is the area of value. I'm not going to trade in between. I'm not going to entertain any garbage trades that don't need to be entertained. If it doesn't get to that area and it doesn't meet my plan, well, then I'm not going to trade it. And that within itself is already mitigating risk, because knowing where you shouldn't trade is also risk mitigation, just as much as knowing how to mitigate the risk of the isolated position itself. And that's what people don't realize. So for me, really simple. Euro dollar, I already know how I'm going to mitigate risk because of the area. 4 hour, we got this 4 hour direction here, waiting for our insurance entry. Insurance entry would do its job. So if I look left and you understand what I mean, what am I waiting for? Something similar to what we had here for this continuation. What do? We broke above the highs, we get our insurance entry, we break the lows. This would be an example. You've probably seen in previous videos where I say, don't cut your trade short for a 2-to-1 or a 1-to-1. This is what I mean. This would be an example of a trade that, let's say you went with a 10 pip stop. If you cut this at, let's say 2-to-1, like, it would be so illogical, but let's say you cut this as 2-to-1. This is such a simple trade. You are not understanding that it is more probable for this to at least equal towards that low. It's almost harming your own edge. Like, when you really think about it, forget about like all of the move and saying, yeah, you should have held it all to this for 18%. I don't care about that. What I'm talking about, even the first low at 3.5, what you've got to realize throughout the year is that how much money, how much profit do you leave on the table of trades that you already take? I'm not talking about extra trades. I'm talking about trades you're already in. Do you really understand if you're cutting them short? And this is what I encourage you to test. You need to test, how far do your winners run? You need to see how far do your winners actually go. So the trades that you win on, I would encourage you to look back through your data and go, right, my last 20 winning trades, I capped them at, say, 2-to-1, 3-to-1, 4-to-1, whatever your system is. How far did they go, and how much discrepancy is there between that? Because you might have won 20 trades, but you might have also lost 30. You might genuinely be in drawdown, but you don't need to be in drawdown, because if you didn't cap your winning trades and you let them run for the potential they have, then you would be profitable. You see how you don't even need to do anything. You just need to let your winners run. And you might think, well, how do I just let my winners run? Now, that could be technical, that could be psychological. A lot of times it is psychological, but also a lot of times it can be technical. But again, I'm shooting in the dark here because I'm speaking as a generalization versus I'm not talking to a specific system. That's for you to decide and for you to test yourself. So that is how I view mitigation of risk through complex corrections and just corrective periods and just consolidations as a whole, is having something in place. And it's not always going to be simple as I explained. There's way more layers to it, but this would be a real-time example of, right, I'm looking at GA, I am interested in shorting this, but only when it meets that criteria. And what that does is it avoids unnecessary losses in these periods and puts me in a strong, unique position where I'm not just hemorrhaging my account for no reason. There are good losses and there are bad losses. And my goal here is to open your eyes up into how can we get you to a point where you avoid unnecessary losses, because you'll be more profitable by default, probably trading more money, making more money, and closer towards your financial goals. Simple as that.